I'm delighted that we've got such a distinguished group. I think probably the first thing that I should do is ask the distinguished group to introduce themselves. I should say that I'm Andrew Hilton. I run a very small think tank in London and share all of those dreadful prejudices that you assume all the Brits do. But nonetheless, I'm here in Brussels and I haven't been shot yet. So perhaps we can run left to right across my radio dial. At the far left, and I assume that that is not a political statement, is...
That is Arne Utnes. I'm the Managing Director of the Norwegian Savings Banks Association, and I'm also responsible for the Deposit Guarantee Scheme of Norway.
And next.
My name is Martin Škopek. I'm representing one of the biggest financial groups operating in CE region, Erste Bank Group. We are in 8 countries, and I'm responsible for roughly 70 million customers across all the territory, retail customers, households, and SMEs.
My name is Jo Swingerdo. I'm head of Department of the Prudential Policy and Financial Stability Division of the National Bank of Belgium.
My name is Matthias Budach. I'm representing La Caixa, which is the biggest savings bank in Spain. I'm responsible for strategy development and regulatory analysis and lobbying activities in the group.
And finally, not on the far right of the panel here.
I'm Gerhard Ruemer from the EUAPNET. It's the European Craft and SME Association. We are representing about 12 million enterprises all over Europe, and I'm the responsible for economic and fiscal policy.
I think the idea of this is to keep it as informal as possible, to avoid anybody getting on their high horse making a speech. However, that having been said, I do hope that we manage to get into some of the detail. But let's first of all respond to Dr. Karas's speech. I think it's important that, that the industry as a whole have an understanding of how CRD4 is going from the Commission to the Parliament and then to God, I guess. Is there anything new in what you heard? What would you pick out as being the key issues? Arne first.
I guess nothing very new, but maybe the most important is that this is very complicated, and you raised a lot of questions, a few answers, and that's, I guess, exactly where we are. And I think from the industry, I think it's an important topic to say that, well, we have to find out the consequences. We used 10 years on Basel II. Now we will have a lot of regulation produced in a few years. We have to be careful.
Martin, what did you pick out?
I would basically follow what my predecessor said. Last time we talked more about the conservation buffers and all the counter-cyclical things. And to my positive surprise, I didn't find anything like breaking in the speech of Mr. Karas, which confirms that we are on the right path addressing the specific issues in details, because the devil is always in the details. So the fundamentals are not questioned, but the implications of certain detailed things, and we will be talking about CRD4 in a moment, are very important to understand what might be the impacts of that.
Jo?
Yes, what I think is important in the whole debate is, and it was also touched upon by Mr. Karas, is the impact on the real economy. And therefore, I think it's the balance between impact on real economy, on credit growth and other things, and the balance with financial stability and sustainable growth in the longer term. And given the current situation we live in, I think there is a price to pay for financial stability, and I'm afraid that price is more capital and more liquidity, but not as part of the answer.
I think he was very clear. He said financial stability is the key and seemed willing to pay a price in terms of the impact on the real economy. That rather surprised me, I have to say. Matthias.
First of all, I think it's important to mention, to welcome the recognition that we do have a change of conditions over the last months and years. And when we first started to draft Basel III until today, I mean, our environment has changed, and there's been changing a lot of things in the financial industry, and especially in the environment. So I think it's very positive that we do have this recognition of this change in conditions. Also, the basis for the parliamentary discussion being the Commission paper, not Basel III, because I think the Commission already, yes, implemented quite some of the important changes, or quite some changes that are quite important to the European Union. In following the idea of there is an important impact, an important price to be paid, and the recognition that one has to be looking very, very carefully into that, I think, yes, we do have to look very, very carefully into that, especially in terms of SME financing as well, and those sectors of the real economy that do not have the ready access and fast access to capital markets. Whereas what I was missing in the speech is a reference to what is liquidity regulation, because we believe and we think that liquidity regulation will be one of the transition mechanisms that might be impacting quite heavily, at least in the transition phase, and due to the changes that we've been seeing over the last years, heavily in the impacting in the real economy. And there's quite some flaws in the current status of the liquidity regulation.
Gerhard, you picked out from Mr. Karas's speech.
The SMEs know very well that Basel III and CDR4 will mean higher costs for SME financing. But I'm very grateful that Karas and also the Commission is saying very clear the most expensive situation for an event for an SME is another crisis. And stability has a price, but it's worth to be paid because we have to avoid another crisis. And the second point is, and I'm very grateful to the Parliament and also to Othmar Karas that he goes in this way, is that we have to do everything to avoid that the wrong people pay the price. It means to discuss this risk-weight story, are the additional costs put on the right bank products in future.
Did you get a sense that the Parliament is sympathetic to that it should be the right people paying the right price?
From the initiative report made by Othmar Karas and the discussion we have with the Parliament is that they have the sensibility to go in this direction. And I think we, together with this saving banks and the cooperative banks, have to prove that a change in the risk weights is justified. That's our job now in the next months.
Can I just ask one question of the schedule, the schedule that Mr. Karas laid out, is that realistic? Do you agree with that schedule? Is that trying to squeeze too much into too short a time? Does anybody want to talk here on the panel about the schedule?
Very short. I think take a look at all the questions and what had happened in the economic situation in the last 2, 3, 4 or 5 weeks. I think it is a good reason to question that timetable, absolutely. And I think it might be too early.
Anybody else want to come in on the schedule? Well, first of all, Matthias.
I think it's important to mention that as there are so many delegations to the EBA in terms of specification and technical details, I think very important to mention that there needs to be the resources in place to actually be able to write down these and to write these technical specifications. And very interesting the idea that to be parallel to the parliamentarian process, because if not, we would have an EBA putting in actually regulation aside from the parliamentarian process. In that sense, I think it's very important, the parallelism of the process, which might be restricting actually the timeline.
Well, there was certainly a reference, was there not, to the need to staff up the EBA.
Right.
I mean, the EBA, I don't know what staff it has at the moment. It's 60 or 70, something like that. It's going to have to grow very fast, very quickly, and to take on new skills. But Matthias. Sorry.
On the timetable, very shortly. I think the current economic situation, with all this, again, increasing uncertainties in the market, are an urgent signal that the regulation should be put or decided as soon as possible. It cannot be too early. We know that this needs time and technical questions has to be solved, but for our point of view, speed up the process as much as possible. The markets need decisions.
Yeah, on the timetable and then on EBA. On the timetable, I agree. It's a complex process, but it's important for everyone, industry and supervisors and regulators, to be aware in due time on the final outcome, having in mind that at the beginning of 2013 this should be implemented. So it's difficult and complex process, but it's key that there will be a final process by the end, by mid-2012, in order to be able to prepare for implementation. On the EBA, there I fully agree what has been said by Dr. Karas, that I think we should go for more differentiation in terms of priorities and in terms of tasks that are dedicated to EBA. Now it is over 200, around 200 deliverables, and many of them are in terms of regulatory or implementing measures, binding technical standards, and I think we should go for more differentiation in terms of priorities, both in content-wise and time-wise.
I mean, this is an enormously complex piece of legislation, is it not? I mean, what's come out of the Commission is, 700 pages of main text, 1,000 pages in total. I mean, it is an enormous undertaking to try and push this through in the kind of time frame that the Parliament, or indeed the Council and the Commission, are talking about. Martin, do you have a view on that?
I mean, in terms of prioritization, how I see the situation, I fully understand that the endorsement of Basel III and finalizing all the technicalities around CRD4 must be done fairly quickly. However, what is on the horizon, and it's kind of clear to everybody, is the sovereign debt crisis. And if you put that into relation as well, what is the proper sequence of steps to take? So what should drive our prioritization in terms of all the regulations that are now in the pipeline?
Can I just move on to the position of the ECBG? The ECBG has listed its main concerns, and I wonder if you could perhaps respond to those sequentially. The first that it's laid out, the ECB is not satisfied with the format of and this is a general level concern amongst the ECBG's members, is not satisfied with the format of the proposed legislation. A regulation does not allow for discretion when transposing legislation. This discretion is of the utmost importance due to national specificities. This certainly in England is a big issue as to whether you go maximum or minimum harmonisation, but the use of a regulation does obviously reduce individual discretion. Is this a concern across the panel? Who would like to come in on this one? This is your trade association is pushing hard on this one. This is numero uno. Arne.
Yes, absolutely, and I think it's good practice to treat the similar cases in a similar way. But if you look at Europe today, and if you look at the banks, they are very different from Norway to Greece, from a small savings bank with 10 employees to a big financial conglomerate, and to treat them exactly the same way. I think that there must be some flexibility to be at the national level.
What do you want, other than a general feeling that you're trying to squeeze, a round peg into a square hole by imposing this? What kind of degree?
Well, for example, we have in Norway our equity certificates, and we want to be able to have that core tier 1 capital, and that should be a local decision because it has the loss absorbing that is necessary. We look at for example, this deposit guarantee scheme, where we probably will be forced to reduce it by 60%. We want to say it's a very big difference between Norway and, let's say, Greek. 100,000 euro is not the same, so there should be some national discussions here.
Is that a general feeling across?
We do perfectly subscribe this in the sense of that there should be some discretion on national level, and then to add a concrete example, if you're thinking about the liquidity regulation and the runoff rates in the LCR, markets are very different in the sense of stickiness of deposits, in the sense of the relationship the customer might have with his or her retail bank. So in some markets, the deposits will be much more sticky than they might be in other markets. So there should be some allowance for models, for internal models of a national discretion towards that. And in the same sense, I'm thinking about SMEs. Currently, SMEs are defined as anything in the sense of liquidity regulation, anything of deposits above 1 million euro. This might be not the same threshold level throughout the whole of the European Union. In some countries, SMEs bigger than 1 million euros are showing a behavior as an SME. In some other countries, SMEs below 1 million euros of deposits already show a behavior more like a corporate. So there should be some leeway to national regulators.
There's no doubt that one size fits all creates also problems. But you also have seen in the past, and also with the Basel II implementation, there was a lot of regulatory arbitrage between member states, and the implementation by the authorities and by the national regulators was quite uneven and didn't neither ensure a level playing field nor was good enough to ensure a strict enforcement of the Basel II rules. And so I think we have to find the right balance, but a little bit more strict and European implementation is necessary to avoid this arbitrage and this, to ensure a level playing field.
Is that the message you're getting out of your membership as well?
Yes.
Anybody else want to come in on that? Yo.
I agree with the last speaker on this. We are, as supervisors, much more reluctant towards national discretion, and so the proposal to put a lot of it in the regulation, I think, is in line with the idea of a single market in order to avoid regulatory arbitrage. And also for institutions, financial institutions, it's difficult to operate across Europe if there are too many or too much national discretions at that level. So I think indeed the right balance, but the idea of a single rule book within a single market pleads for arguments in favor of regulation.
Certainly in the UK, we seem to have an interesting split with the government, much keener on national discretion than the industry itself. I mean, Angela Knight, the chairman of the BBA, has been banging on about the need for limiting any kind of discretion whatsoever, though of course she's concerned about maximum. She's concerned that the UK will push, after the Vickers Commission will push up capital standards. The second issue that the ESBG has raised is that of liquidity, the new liquidity standards, specifically the liquidity coverage ratio and the net stable funding ratio. Is this a concern? I presume it is a concern that's very widely shared. Arne first.
Yes, I think it's the biggest concern ever for the banks, because if you really have problem, then if you have shortage of liquidity or break the regulation. So that is very important. And I think they also said here it's wise to have a further discussion to be quite sure that you define what is the best liquidity, and that is so far not done, but that's very important to do and do it thoroughly. Look, for example, at the covered bonds. I know covered bonds are not the same around Europe, so talking about the national discretions, you might also end up maybe with different conclusions, but at least this is very important to be focused and precise on.
Martin.
Besides the net stable funding ratio, which is a bit off the table in terms of its implementation, yes, liquidity coverage ratio is an issue. And it goes back even to some comments of Dr. Karas that the capital requirements will not hinder too much SME lending, which I might agree on. It will be more costly, but what might create a different paradigm for SME lending is the liquidity coverage ratio, because as it is defined today in its narrow scope, it does not fit to any kind of what I call CEE type of banking franchise that is really from 80 to 85% dependent on loans rather than bonds. So LCR is for sure an issue in terms of its definition. I'm not talking about national discretion. I'm really talking about wider and more fitting and better fitting definition of LCR.
Do either of you two want to come in on that?
I think we should stop discussing if we need liquidity ratio or not, because the crisis has shown we need some security on this side, and the other side is, of course, it is important to define them correctly, and they should be defined in a way which ensures liquidity without making business impossible. Therefore, we have now this 3, 4, 5 years for observation, and we have together do everything to get them right 2015 and 2018, but we need a positive approach to liquidity ratio and also the net stable funding ratio. We need these kind of regulations in the system.
Speaking as a regulator, you would obviously endorse that, Jo.
Of course. And speaking as today, it is crucial that it is obvious that liquidity is the crucial problem in the European banking system as we speak now and in Belgium. So indeed, it is crucial, and we should indeed not discuss anymore the principle itself. 2015 LCR will be there for the net stable funding. I think there is more nuance in terms of observation and having an observation period and taking the right, draw the right lessons from that observation period. I think in terms of the banking models that as a result of these new requirements will pop up in Europe, it is clear today that retail banking and having access to stable funding will be of utmost importance in the coming years. And so a banking model based on retail, and I think our representatives in the room here, will be of added value even more than yesterday, given that new context.
I assume that the liquidity issue is an enormous issue for all of you. I mean, is there anybody from the floor who wants to either ask a question or interject here? I do believe that we have microphones, but is there anybody who wants to come in on that? While you're thinking about it, I mean, Matthias, do you want to add anything on it?
No, I think we do need to stop the discussion about whether it's necessary or not, but we do need to get it right. And we need to get it right in the sense of the change of condition that we've been living over the last couple of months. We are right now in one of the worst liquidity strains in many of the systems, in many of the financial systems, and we are about to introduce a new liquidity ratio, which is basically based on the holding of government debt as liquid assets. So we are about to introduce an asset class that which is supposed to be the most highly liquid and less risky asset class. We are reducing the importance of covered bonds. We're reducing the importance of those type of instruments that actually banks are using to finance then the mortgage loans or the loans that are giving to the real economy at the moment where there are serious doubts about the quality, both in terms of liquidity and in terms of solvency, obviously, of this type of asset classes. So I think that shows us that we need to get it right as soon as markets anticipate. There's a very much a danger of, well, we might getting it right by 2015 or by 2018. We've been seeing from capital regulation that the market anticipates and will anticipate. Market is anticipating already. So they will anticipate liquidity regulation. If we don't get it right and if we don't start discussing these issues now, market will anticipate a situation which then might lead to real damage at the very moment.
Jo, can I ask you about the liquidity ratio and the vulnerability of banks to sovereign debt? I mean, sovereign debt is not what it used to be.
No, indeed. And of course, this was designed at the moment that there was another perception of the quality of sovereign debt. So I think indeed we should have, and there is a risk, as explained, if markets anticipate on the rules, both on liquidity and capital, which is clearly being the case, then there is indeed a risk that there is not sufficient time to address unintended consequences, and especially in the liquidity domain where we have less experience compared to the capital domain where we have experience with Basel II. This is clearly less the case for liquidity, where we should have that, where we need that time between now and 2015, now and 2018, to see what could be unintended consequences and to address these issues.
There is a question here.
Thank you.
Just identify yourself.
Jean Asselin, BPCE, Banque Populaire Caisse d'Épargne. There is a rumor that, just to expand on what you've just been saying about the observation period and anticipation, there is a rumor that the Basel Committee would come up with guidelines on liquidity as early as 2012. Now, if that is to be the case, I mean, surely this is going to have a very, very significant impact on the actual viability of the observation period. I mean, it sort of kills the observation period. So I was wondering what sort of reaction you would have. Maybe Dr. Karas. Oh, he's left.
I think he's disappeared. He has gone away in a puff of smoke and a Mercedes. First of all, is this rumor floating around? Anybody heard the rumor? No. If the rumor were proven to be true, would it be of concern? Do you want to come in on this? Anyone? Yo.
I think
as our regulator on the panel.
I'm not sure if we are completely on the same line. It's true that the Basel Committee is still working on further implementation guidelines, but the text of the CRD is out there. There will be, of course, implementation measures to be taken also by EBA, but there is now also a period of monitoring the whole process, and this will going forward. I think, as said before, it's crucial that we, for liquidity even more than capital, that we use that period to look how what is the impact for the institutions on these new rules, in order to be able to have a fully fledged and final framework in time to implement in 2015.
Any additions on that? Let me then move to a point that is the third point that the ESBG has as its general concerns about CRD4. But it's also a point that Martin brought up specifically. He wanted to be sure that we address it, and that is the impact on lending to SMEs. So just lay out, if you would, Martin, your concerns here in a fairly general sort of 10,000-meter way.
I mean, I would start from the broader perspective, just depicting what is the situation, what might be the situation like in our specific case. So we are serving around 800,000 of SME customers across 8 markets. If you look at the situation of the SME market today, of course, this is one of the high vulnerable segments if the situation turns sour and there is a crisis either on the way or already happening. This segment, as I said, is very much dependent, even from 85% to traditional lending. They don't have access, due to various reasons, to well-established capital markets, so bond issuance is very limited. If there are bonds, not rated at all, so very much high dependence on lending. From the capital side, lending will definitely become more expensive. That's for sure, because the new capital requirements will make it more difficult to get reasonably priced loans. At the same time, on the liquidity side, if all those credit obligations will not be recognized as a part of highly liquid assets or under certain eligibility criteria, then we are basically do not have any clear motivation why to keep those, why to originate and keep those loans until their maturity. So in that sense, the incentive for the banks that are running very traditional business model as our bank is fairly limited to support that segment. I'm not saying that we would walk away, but if you take it as an extreme case, that segment will be very much in vain, because there is no incentive, rather disincentive, that is coming out from CRD4 now.
I would assume that you at La Caixa feel much the same way on this.
We do definitely much feel the same way, and especially I've got the feeling that the discussion now goes to the SMEs, actually both SMEs and big corporates in Europe, but we are much more dependent on bank finance than our counterparts in the US or in other regions, and this feeling of we need to move that to the market. But we need to make sure first that they are difficult to move to the market just because of transparency issues and information issues, and secondly, to really want to move these type of loans, and this might be one of the consequences, the unintended consequences, do we want to move them to the market, knowing that markets are as or more volatile than the banking sector is, and have less access then to lend of last resort financing, maybe from the central bank. So actually, it can't be a objective of regulation to try to reduce the dependence on bank finance, which has proven to be more stable than dependence on market finance.
Do you anticipate that it will have a major impact as you envisage it going through the process? What comes out at the end of the sausage grinder, is this going to be bad for SMEs?
This is going to have an impact in the sense of we've got a general increase of capital requirements, we've got a general increase of liquidity requirements, we've got a specific issue in SMEs in terms of liquidity, as I mentioned before, that there's that we're taking SMEs over 1 million of deposits and putting them in the same bucket as they were large corporates. So there is an issue, a general issue. And then, if you've got a general problem in terms of finance, in terms of cost of finance for the banks, the customers first noting the impact or feeling the impact are the ones that do not have the alternative to walk away and to go to the markets. So we will have the big companies walking away and go to the markets, and the ones that have to stick with bank finance, they will stick with bank finance, but at higher prices, crowding out some part of it.
What did you pick up from Dr. Karas's speech on that? Because and certainly on the English translation that I heard, he seemed positively to be promoting the idea of greater access to the markets. It's an unintended, it's a sad consequence if bank credit becomes a little less available or more expensive, but it would be a good thing generally if more companies were able to go to the market. Is that the message that you were picking up as well?
This is the message I was picking up, and this is why I'm saying we need to be cautious about this goal of substituting bank financing with market finance, especially in segments that might be vulnerable to the high volatilities we're seeing in the markets.
Arne?
Well, I think all lending will be more expensive. You are going to have more liquidity, more equity, more everything, and that will cost money, a lot of money. And I think the SME segment is will be hit hardest, because if you look at the household market, the competition is strong, the risk is rather low, and you have covered bonds to finance it. And the large companies, they can go abroad, they can take their own bonds. So I think, fortunately, your members are, I am afraid they will be hit hardest.
Is this the classic example of the wrong people paying the price for the crisis?
I think the story is much more complex, and I cannot speak about everything now. But the first thing is, already since Basel II and since the changes on the financial sector in general during the last 20 years, we see that bank lending becomes more and more a problem for SMEs when it's about financing riskier projects, startup, business transfer, innovation, internationalization. Everywhere there's a little bit more risk in, the banks are more and more hesitating to give normal loans. Therefore, what we are doing is, on the one side, to increase the public support for this type of loans by guarantee schemes, etc., etc., and on the other side, to help the market to develop new products, mezzanine finance, unsecured loans, participation capital, etc., etc., to step in instead of the classical loan. This is the one story. The other story, in the narrower sense on SME lending, we have seen now with the crisis already without Basel III, that of course the prices went up, the demand on information and collaterals, etc., went up. But on the other side, SME money for SMEs was never so cheap than before the crisis. So we have also to balance this a little bit. And the banks should earn money with SMEs. And as long as they earn money with SMEs, they will lend money. And if they don't earn money with SMEs, then there's something wrong. This is not the case. All, as you are here, you earn money with SMEs lending, and this is the reason why you will continue them, and there's no other reason than you make money with us. So, and the last aspect is that, as I said in the beginning, even it becomes more expensive now, it is less a problem if it's a stable development. What we have seen with the pro-cyclical developments of the markets, before the crisis, after the crisis, what we have seen, the enormous costs for taxpayers, and SMEs and our employees are the largest taxpayers in Europe. And what the costs of the recession is such enormous higher than paying, let's say, 50 or 100 basic points more for a loan. That will be the reality. And if it's not feasible for an SME to pay these higher prices, which all the competitors have to do the same, yeah, they will go out of the market or it will go for other financial instruments. That's the reality.
Can I ask you, let's turn it around and look not at the SME clients, but at the ESBG members. Is the ESBG membership, particularly the mutual end, the smaller end, is it geared up to provide the kind of finance and the kind of financial advice, the kind of hand-holding to make a foray into the markets that CRD4 will actually push the industry in the direction of? I mean, you represent one of the, as it were, bigger, more sophisticated institutions in the market. You should clean up. All the little boys won't be able to compete with specialist knowledge of capital markets.
For sure, there might be, and one of the possible consequences might be just that we might see some concentration of the type of business that needs more sophistication, that needs more scale, that needs more scale in the innovation processes as well. We might see some concentration of players, and obviously, if there's a business out there, there's somebody to run after the business, and if there's a business out there, and if there's money to be made, then there will be the innovation, and there will be the offer, and there will be the product offering to be made.
So we're going to force the entire ESBG membership into the world of financial engineering, just at the right time, I would have thought. Arne.
This is a mistake I foresee. If you look at the financial crisis, which banks succeeded best or had the less failure? Well, it was the smaller and medium-sized banks. Why? Because they have the knowledge of their market, and as long as they believed in the church tower principle, don't lend money out to a customer you can see from the local church tower, they succeed. And I think you don't have to be more sophisticated than your customers. And most of the ESBG members, they are sophisticated enough compared to their customers. So I don't think you need to have structural change here. On the opposite, I think it's very important that it is pluralism in the banking industry. That is one of the guarantees for a stable situation, in fact.
Martin, do you want to?
Just if you take one step further, I understand that there must be certain price for stability, and this I understand, but it goes back again to the question, is it fair to communicate to this very important segment, especially in our territory of CE region, to say we have to pay a certain price for stability, and you guys who didn't cause the troubles of unstable financial sector, you have to pay the price, and on the top of that, we are agreeing on the regulations that makes incentives for the bank to serve you well and to provide you adequate financing. So what I'm trying to say, that if we talk about is there an impact to SME or not, it definitely does not help to serve and provide better products and financial services to SMEs, which are absolutely vital for our new economies. Because in many countries, they form from 30 to 40% of industrial outputs. And that's my concern. I'm fine with paying the price for stability, but is it really the right segment that should be rightly penalized for something what they have not caused?
Yo, speaking on behalf of the global regulatory authorities. Sorry, that was a joke.
I'm not completely convinced that SME lending is hardest hit by the global reform package. I think it's a little bit more nuanced, especially if you take also into account the earlier reforms, the Basel 2.5 that has been transposed into CRD3 in terms of trading book activities or securitization. And if you look to the global package, I think the impact on SME lending there is a price. I'm not sure it is the hardest hit on that side, for good reasons. So the question is not, is it too low or too high, the capital requirements? The question is it the right capital requirements? Is it in line with the risk profile of the type of activities? And of course, we all hope that that Basel III is going into the right direction in that perspective. Then coming back on the impact on the economy as a whole, we've said at the beginning there is a price for stability, but remember the studies that has been done by the Basel Committee and other international, at least more public-oriented fora and organizations, where the impact on the real economy was very modest or very low. And I think that should be all, and that's mainly because the impact on the granting loans also to SMEs is part of that overall assessment of the impact on the real economy.
Are you convinced by the Basel work on the economic impact on SMEs?
No, we are not convinced. I think they didn't really look on specific impact on SMEs, but they did macroeconomic analysis, working with aggregated figures, which did not reflect the concrete situation of SMEs. But I agree it is very, very difficult to do it. We had a lot of discussion with the European Commission how to analyze this, but it is not easy to do it. But I agree also what Martin said. Of course, we don't want to pay everything, and this is the reason why we say we have also to do something on the risk weight side, on the active side of the balance sheets. This is the reason why we say we have in the implementation in Europe to help or to recognize the specificities of the saving bank and the cooperative bank sector, to allow them to continue SME financing, because we know also during the crisis, especially during the crisis, that the saving banks and the cooperative banks kept on SME lending and helped us to survive during the crisis, etc., etc. This is also well recognized. But what we not can accept is, and I'm not excusing you now, but in general, say, we don't want to have regulation, and therefore we say if you do regulate, then we will SME not finance anymore. It's a little blunt now, but this argument also doesn't help, because we need better regulations, and we have to work together on the right regulations, and I think this is the task, and we made a lot. When I remember the last conference, last autumn, we were also sitting on this podium here, another room. We made a lot of progress and had a lot of success till now. We're not in the end, but okay, in 1 year's time we will be even further.
Reasonable optimism. Arnie?
Yes, a short comment to that. I think everybody agrees that, and the banking industry accepts that there have to be regulation. Of course, I think it is already one of the most regulated industries in the world, but nevertheless it must have good regulation then, and we have seen the crisis is partly because some of the regulation was not good. The other is that this will cost for everybody. If you want more liquidity, equity, it is a price. And you have to pay it, and we have to pay it in common. Also, probably the equity owners or the banks. But there is a danger here, and if you have too much burden and too much cost on the banks, then the credit will go others in the unregulated market, and that was one of the reasons why we have a financial crisis, just because you had a lot of unregulated credits. So there is a limit here also. You can, if the burden is too high, well, then the banks are not competitive. You get very solid, very liquid, and very small banks.
But do you accept Gerhard's point that progress has been made, that this message is getting through? I mean, that I find encouraging.
I think we do absolutely agree on that there is a need for regulation, there's a need for change, there's a need that we've seen a lot of things that did not work the way it worked, and that a lot has been done. And as Mr. Karas pointed out, from the Basel III proposal to the European Commission proposals, there have been changes have been done, there's been a common discussion, and we're not at the end of the process yet, and this is going to go on. I think the point here is try to, as as long as we see the danger of unintended consequences on the way, we need to point them out. We need to discuss about these. We need to make sure that we take all the knowledge that is around the table from all the types of constituencies and interest groups, in order to make sure that we form a package which is as round and the best possible in that time frame that as well is given to us, in the sense of we do need a time frame. We do need to put a stop to the process. And think about the macroeconomic, and the same holds true for the macroeconomic impact estimations. We're looking at the work of the macroeconomic expert group of the Basel Committee. We're looking at the work of the IIF or of other institutions, and there's a huge diversity of potential impact studies. And even the same MAC group of the Basel Committee has a huge diversity in the models that were prepared by the different regulators. So there's a lot of uncertainty out there. To the extent to the real impact afterwards. So I think there's a need. A lot is done, and a lot is to be done still.
Obviously there's a huge political pressure in this direction, given that SMEs produce, small companies produce jobs, large companies destroy them. One has always assumed, looking from Britain, that the Mittelstand owns the European Parliament, but that's really our problem. Is there anyone in the audience here who wants to expand on concerns about the SME sector and lending to the SME sector? I mean, this strikes me as enormously important, and if there is anybody who wants to come in, feel free, but I cannot see a hand. If that's the case, let me. One of the other points that came up on the list of questions that I was asked to bring up is also one of the specific points that the SBG has raised, and that's the treatment of minority interest for consolidated capital. Again, this came from Martin, but it's a general point, and I think Matthias has also raised it. But first, well, let me ask, Matthias, you lay out what you consider to be the main concern here.
I mean, I've had a concern, I think, which is not necessarily the same concern as Martin, so I'll focus on the part of my concern. The concern is that in the current status, both of the Basel proposal as well as of the Commission proposal, minority interests that arise from non-banking subsidiaries are not considered as forming part of the capital of the mother company. Now we have in some constituencies, in some countries, you do have business models that are diversifying away from the pure financial business into some other long-term investment businesses, as we do have in Spain, where the banking sector actually also has the role of a long-term investor to strategic and important infrastructure industries. So there is a cap to the way to raise capital by floating partially these type of subsidiaries, because if you're floating non-banking subsidiaries, the capital we raise, which is new capital, which is not double leveraging capital, which is new capital that is coming from outside investors, we're not able to include that in our capital calculation. The same holds true for the current situation of the real estate crisis we are living in some of the countries of the European Union, especially in Spain. We are obviously at some stage accumulating real estate assets on our books. So one of the strategies would be floating these real estate companies we are founding and getting in capital from the market in order to help us to manage these real estate books. And this type of capital that might be flowing towards the banking sector is not taken into consideration as capital from the Basel III point of view. So there's some auxiliary businesses, say, that two banking institutions might do co-investments in services businesses that are more transactional based, that are not themselves banking institutions, which is so diversification, international cooperation in non-banking businesses is hampered, which is of major concern for us and for many other institutions.
Martin, you would go even beyond that.
I would basically divide that into two things. One, there is not Erste Bank specific, and it's more like specific to any foreign bank that has its own subsidiaries across the region. And what I found here a bit counterintuitive is the fact that those banks are running their subsidiaries in other countries on very high level of capitalization. In our case, we have all the subsidiaries around 14.5%. From whatever reasons, and there might be historical, political, whatever, privatization reasons, we do not have all subsidiaries 100% owned. This might be one solution for that inadequate reflection of how minorities are treated in terms of capital consolidation on the group level, but we cannot afford to have it. We cannot afford to have 100% owned subsidiaries across all the countries where we operate. And then you are in the situation that you are running a subsidiary that is well capitalized, fulfilling all the minimum and even exceeding all the minimum regulatory requirements. 14.5% is relatively high. And you cannot basically utilize all the excess capital that is brought into that company in order to compensate full risk that is coming out from the risk-weighted assets. So you have full portion and full load coming from risk-weighted assets, but inadequate proportion of the excess capital you are deploying in particular country. So this is a general problem. The second layer of that issue is a specific Austrian case where we established a very well functioning cross-guarantee system with 57 other Sparkassen savings bank included into that so-called Haftungsverbund, the cross-guarantee system. And here we have many mechanisms how to make sure that if one entity is really going into troubles, liquidity-wise, capital-wise, we are coming into the rescue to solve the situation out. It's full risk-absorbing mechanism. That was even before the crisis, and during the crisis several times declared as potential role model for other countries to follow. And suddenly that minority capital treatment is really hindering the whole idea of that full absorbing cross-guarantee system. So we do have an issue in that respect. Why we should consolidate all the risk-weighted assets in full extent and do not enjoy the excess capital that we have in those participations where we do not own them for 100%. So it is an issue. And I'm glad that even Mr. Karas mentioned that in his speech.
Arne, do you want to come in?
Yes, I agree. And I think in general, if small savings banks especially will merge, then they have to cooperate through alliances. And it's very important that the rules and regulation around that make it as easy as possible so they are able to take out economies and scope and scale without merging.
Gerhard, your membership?
I'm not an expert on
You're an expert on everything. But all right, let's turn to you. Obviously, this is a very live debate in the regulatory community. How have you got to the position that you've got to on it?
Yeah. So I have to defend all the aspects of CRD4, even if that's not always easy to do, I think. And this is maybe one of these cases. I think you should look at, it's part of the global debate on the quality of capital. It is an issue. I think it's difficult, and that's more a general remark in terms of level playing field. This is a compromise that has been made in Basel, and the question is it doable? I think not to deviate from it at European level. So it is part of the global package. And it was very well explained. I think we should make the nuance on between, on the one hand, it is recognized, of course, as fully fledged capital at the level of the subsidiary. It's only the excess capital which is not recognized at the consolidated level, for reasons that that excess level that has not its loss absorption capacity at the level of that parent company. So that's the explanation why, and of course then there was a whole debate, and the ultimate outcome was the compromise we all know. The only thing, what was the driver is that there is no loss absorption capacity of that excess capital at parent company level, and that was the reason why it was not recognized at consolidated level, but of course it is at subsidiary level.
Do you want to come back on that, Martin?
I understand the explanation. I'm still a bit missing the initial logic, why it has been done that way. I understand what you said, but still the initial rationale. But we can have it.
If there is a problem within the group cannot use it. It can only be used at a level of the subsidiary where the capital is established, let's say, where the capital is available. There are limitations in terms of transfer, and it's clearly not available at the level of the parent company. So, of course, this will have consequences also in terms of distribution of risks, because the only way to accommodate to that is also to have an appropriate division of risks within the group, and also with potentially unintended consequences. If you have to transfer risk to those who are maybe not best suited or best placed to manage that risk. So there are issues, but I try to explain what was the initial driver.
Any questions in the audience on the issue of minority interests? Let me ask one other question then. What's the impact of CRD4 Basel III going to be on the ability of ESBG members to operate in third countries? It's been suggested that it might have an impact on, in particular, Central and Eastern Europe. Well, Central Europe is more or less within the Basel bailiwick. Eastern Europe is not. Martin, this is a concern for you?
I mean, yes and no, because if we want to stick to our business model that is around almost 200 years, and it's very traditional for someone boring business model, just gathering deposits and providing lending to the end customers, be it private individuals and households or companies, and we do not want to deviate from that model, there might be consequences, because we will have, in that sense, higher capital requirements in terms of quantity, in terms of quality. That might become more expensive. Hunt and search for liquidity will also have adverse impact on interest expense we would be paying. So there will be adverse impacts. Overall, I don't like that situation, because we are again talking about the financial model that proved to be very resilient and very stable before the crisis, during the crisis. And again, I'm not sure that we can be called as the one causing the crisis with that traditional, very boring, stodgy banking model. So in that sense, I don't like it too much, so there will be negative consequences. I'm not against regulation, but I'm just trying to get them right.
But are ESBG members going to find themselves, and particularly, I guess, the smaller ones, going to find themselves at a competitive disadvantage in third markets?
I think it's not that much a question of size, but a question of the type of business model they're using in order to expand in different markets. And we see on the one hand the business model of Erste Bank, which is a business model of controlling states, but not necessarily 100% owned. And there's the issue of minority interest that we just mentioned. There's the other issue of expanding into other markets, being it geographic markets or being in other market niches, by minority stakes, minority investments in other companies, as our company is doing in terms of stepwise internationalization process. Like start out with a small investment stake, get to know the partner, and start doing things together with the partner. And here Basel III and CRD4 are very, very restrictive in the sense of deducting the entire investment that is done in that financial institution from the core capital basis. So this type of prudent, step-by-step, little-by-little internationalization strategies, which is not a outright purchase of 100% of a controlling stake, which would be from a business strategy, a more risky strategy. This type of prudent strategies are discouraged in 34. So, if we do have institutions which are smaller, which are less access to capital markets, which are reliant on a step-by-step process, so yes, I do think there's limitations from Basel III and CRD4 in that sense. So
it basically discriminates against just holding hands on a first date. Now you have to hop into bed on a first date.
Correct.
Is that a general? I mean, it seems to me a very plausible concern that you've raised. Is that a general concern? I mean, Gerhard, are you?
To be frank, we have never discussed this aspect, but it sounds reasonable. Yeah?
What will it do? What will it do to a company like La Caixa?
It does to us, first of all, a much higher capital need, obviously, a much higher capital cost for the type of internationalization strategy we are, internationalization and or diversification strategy that we are having. That leads to the strategic discussion, obviously, internally, to say this type of strategies are these the type of strategies you want to keep on moving on, and that the decision is and was that we keep on moving on with this type of strategy, but it increases cost, it increases capital cost, and it increases it makes more difficult this type of strategies.
I mean, it's going to cramp your style as well, Erste Bank. It will cramp your style. It will make it much harder for you to expand, as it were, incrementally.
It will, because all the expansions will be much more costly in this new environment. So that's clear. Even within the current territories, or even if we aspire to expand further beyond.
As a regulator, is this a concern? I mean, is this yet another force pushing for greater consolidation in the financial industry? And if so, do you as a regulator see consolidation as a good thing, or do you see diversity as a good thing? Let 1,000 flowers bloom, or let's have fewer flowers in the garden but bigger and better ones?
I think that diversity is a good thing also from point of view of a regulator or supervisor. So I think that's not the issue. I would like to come back on the level playing field issue, and also that's a key issue, I think, in terms not only within the EU but also for all Basel member states. We have 27 Basel member states, 30 EEA members, that there will be a level playing field also in implementing Basel III around the globe in the same way. We have some experience in the past that were not so convincing in that respect. So that's, I think, an important issue. And then on the consolidation, I'm not convinced that this will lead to a bigger consolidation. As said, there are banking models that are very sound, that have proven to be resilient in difficult times. And I'm not convinced, or I'm not sure that Basel III will become more difficult for this type of business model compared to, for example, Basel II, given the huge capital increases for some types of activities which are a little bit out the scope of, let's say, the classic banking model.
Fewer flowers, but more better quality. And bigger flowers. But if you look at the financial crisis, that was the problem. If you have a European champion, we really have a problem with the. So big is not always beautiful. I want to underline that.
In your program, session 3, CRD4, steadying hand or stranglehold, there are actually 4 questions that the SBG has raised. And the first is a very, very general one, and I thought at the end of this panel session we should address these sort of almost philosophical questions. The first one really is, what influence will Basel III CRD4 exert on retail banking in the short and medium term? This is a sort of, God question. It's sort of teleological. But nonetheless, I mean, I think it's very important. What do you think the shape of retail banking in Europe is going to look like? Let me be specific. 7 or 8 years out, once CRD4 is really in operation. Gerhard, close your eyes and look into the future. I realize, bankers who do that are terrifying.
No, I think I want to make 2 comments. The first thing is, if we are not succeeding to do something on the risk weight side, to, let's say, to make it easier and less costly to retail banking.
All right, well, let's ask all our panel members on this, because we've ignored the risk weighting issue. Yeah. All right, that is, of course, the other side of the balance sheet completely. What is your concern there?
Here, if we agree all together that the retail banking was not causing the current crisis, but the current crisis forced us to increase the quality and quantity of capital, then the capital should be better linked to the part of the banking business which caused the crisis, and not to retail banking, which didn't make the problems. So to correct the risk weight, that the capital requirements for retail banking are kept more or less stable by reducing the 75% to 60% or even a little bit less, etc., would have a certain kind of correction to the possible negative impact on retail banking coming from this side. The second thing is that if we don't get right the regulation on the quality of capital and the kind of capital accepted, we will have, let's say, a centralization of the retail banking sectors, which are not in the interests and also not in favor of the real small decentralized SME sectors all over Europe. So I think what has been said here, I'm not so sure if the current regulation as it is at the moment as regards minorities and as regards the treatment of groups, if this is not better solved than at the moment, we will have concentration in the sector.
So, two issues there, the risk-weighted assets and the quality of the capital. Are these, your two major concerns looking out? And where do you think, is there wiggle room? Is there still negotiating room on this?
I think I want to be positive on these things, in the sense of a lot of progress has been made. The discussions we are having and that we had and that we will be having in the future are positive and will lead to results and will lead to better results. So yes, I do think quite some of the unintended consequences. As an example, might be the way financial conglomerates and bank insurance conglomerates have been treated, and the Commission proposal actually treats them more favorable than the Basel III initial proposal does. So there has been progress made in a lot of fields, and I want to be confident that there will be more progress made in many fields, both in the business model impacting type of regulation, which might be minority interest or deduction from capital of investments, of minority investments, as well as tackling at some stage, and it is in the Commission proposal, very specifically and explicitly tackling the question of risk weighting in the SME area, to make sure that the price is paid by the right agents. So I think yes, there is room for improvement, and we should be positive and think that there will be some improvement. However, there is the risk. There's the risk of having a less diversified, both geographically and in terms of business diversification, and more concentrated retail banking environment, especially from the very small institutions. So I think the very small institutions will find it harder and will want to look for more economies of scale, as it is happening at that very moment in the Spanish sector. We have been going down from 45 institutions to 15 institutions over the last 14 months.
Arne?
Well, difficult question, but if to try to sum up, I think, of course, you learn from crisis. That is, and of course, the intention by these rules, and they are, if you look one on one, very reasonable, most of them. My fear is that if you don't take, point one, you need clear rules, very clear rules, and as soon as possible, and it may be separated from implementation. But nevertheless, the market, as soon as you have the rules, the market tend to demand it from day one, implementation or not. So that is maybe also a challenge because of the situation in the economy. But nevertheless, I think if we now have a good process, we, as it always is, you start up with a rather tough thing, and then you try to, you have a debate around it, and you end up with a reasonable regulation, with the reasonable possibilities to adjust also for specialities in each country. I think you should have a better financial industry afterwards.
Martin?
Yeah. Tough question to be answered in short, but not having too many assumptions at the same time, because it would make the whole thing very convoluted. But one assumption: if we stick to our traditional banking model as presented by Erste. So if we do not want to make any crazy things that we would suddenly walk away from lending to certain segments and start heavily buying sovereign bonds and keeping them till maturity to improve all the regulatory requirements and ratios. So sticking to our current business model, we will be definitely less attractive from the investor's point of view because the whole business structure will be more costly. We will be still providing the same service for the ultimate customers of ours, being households and mid-sized companies, so we will be still around. And the less attractivity and less returns are kind of unavoidable. This is clear.
Jo.
Issues of concern, I think we mentioned them during our conversation, is the risk of anticipation, that the market will force anticipation, but the whole framework was designed taking into account the phase-in period. So that's, I think, an issue. Second issue is the issue of level playing field, as said, that it will be implemented across the globe in a coherent and convergent way. I think a point where we didn't touch upon was we focused on capital and liquidity. It's mainly pillar 1, let's say. We didn't say a word on pillar 2, but I think also pillar 2 will also in the new framework and in the new world remain a crucial element of banking supervision in terms of adequate risk management and governance arrangements. Having said that, I think the situation for retail banking, I'm not too pessimistic, I'm rather optimistic, if at least the assumption that the incentive structure that we is set right under Basel III, then and also given what I said before in terms of the added value of having a retail network that is delivering funding, which is of crucial importance in these days and in the coming periods. We haven't discussed it. Pillar 2 is the area where certainly there's more wiggle room for regulators. Just talk a little bit about how Pillar 2 can be developed, or how you will see Pillar 2 developing in the context of the implementation of CRD4. I think at least I hope that it will remain on the agenda, because now the focus, as I said, is mainly on the new capital requirements, liquidity requirements. But one day the focus will shift again to Pillar 2, and I think that's for good reasons. First of all, because the assessment of the risk management framework, globally, governance framework, and arrangements around remains crucial. Having said that, then you have the element of the assessment of the internal process, the so-called ECAP assessment by supervisors. And there I think that's a crucial element within Europe, to have more convergence on the way this is done by the different national supervisors. When we have to supervise international active groups within supervisory colleges, it's crucial that we have the same methodology of assessing the risk profile of an institution. And I think there also there is a role for EBA. EBA will focusing over the next years on the regulatory side, but on, let's say, the more operational side, convergence of supervisory practices in terms of having a more convergent view on the risk profile, which suppose that we have a common view on the methodology to assess the risks, is, I think, crucial in order to be able, within, for example, a supervisory college, to come to a common view on the capital needs and the capital add-ons that has to be decided within the college. Our closing speaker has finally arrived, and I'm delighted that you stayed around to hear him, and I'm also delighted that our panel managed to fill the last 2 hours extraordinarily productively. Can I thank you all for a terrific job? Well done. Many, many, many thanks.